Welcome. In this video, we're going to analyze the US dollar to Japanese yen, one of the longest-standing markets in the global financial system. Before we begin, one important note. Every chart in this series will be analyzed using a logarithmic scale, never a linear one. Logarithmic charts preserve proportional price movement over long periods of time, making them essential when studying markets with decades of history. The yen's modern history begins in 1971, the year the United States abandoned the gold standard and the US dollar was officially decoupled from gold. That event fundamentally reshaped the global monetary system and became one of the defining pivot points in the history of the forex market. Because we're working with more than 50 years of price history, we begin from the highest practical time frame, the 6-month chart. As a general principle, the longer the market's history, the higher the time frame we should start with. Our objective at this stage is to identify what I call the early conditions, the original reference points from which the market structure evolved. I like to think of these early conditions as the market's genetic code. Every candle inherits information from those that came before it. Every major turning point is connected to previous ones, creating a continuous chain of dependency that gradually shapes the market's entire structure over time. The first thing I study is the structure itself. Before drawing anything, I simply observe the market and ask one question. What is the market trying to do? Looking at the long-term structure, we can clearly see a remarkably clean downward expansion that has been unfolding since 1971. The next step is to verify the correct expansion angle. I do this by examining how price behaves around the projected levels and by studying the character of each interaction. I'm looking for a natural oscillation around the expansion attractor. When price repeatedly oscillates around that attractor with precision, it confirms that the Gann expansion grid has been positioned correctly. Once that relationship is established, the geometry becomes meaningful rather than arbitrary. The market then reveals a familiar sequence. First comes expansion. After expansion comes contraction, a period during which energy is accumulated. That stored energy eventually produces another expansion. Even without drawing additional tools, the structure already begins to reveal something important. Its character is changing. That change suggests the possibility that an entirely new expansion cycle is beginning. To investigate this, I mark the fractal early condition point. From there, I begin decomposing the historical price range using the block system. Each block represents a structural layer of the market. Its center of gravity defines the equilibrium level that governs both price and its underlying frequency. These are precisely the levels the market continues to react to today. Working on a 6-month time frame naturally introduces a significant amount of visual information. Too many levels create noise, and noise reduces clarity. For that reason, I eliminate everything that is not essential, keeping only the structural levels that contribute to the analysis. The goal is to preserve the most valuable analytical tool any technical analyst possesses, the eye. Finally, I add a Fibonacci extension, measured from the early conditions. The measurement is always taken from wave 1 to wave 2, projecting forward to wave 3. The reason is straightforward. The first impulse that creates a wave establishes the framework for everything that follows. That initial movement governs the market from behind the scenes, long after it has disappeared from immediate view. I apply the same methodology using the extension tool on the first waves that emerged in 1971. At this stage, I retain only the 2.0 extension level, because it is the structural level that is currently most relevant to the market. Now we have something important. Before adding a single block or performing any current price action analysis, we already have the horizontal structural levels around which the market naturally oscillates. These levels define the market's long-term equilibrium. But structure alone isn't enough. I also need an element of time. To introduce that dimension, I derive the market's trend angle in order to identify what I call the backbone. I determine that angle by connecting structural blocks both above and below the current price. Once the trend angle is established, I can divide the entire range into proportional segments. This allows me to identify where the backbone lies, the 0.5 level of the trend, as well as the location of its primary attractor. As you can see, price has already oscillated around the backbone. More importantly, it appears that the backbone has undergone a polarity shift. In other words, what once acted as an attractive force is now behaving as a repulsive one. At the moment, the market is attempting to establish acceptance above the upper shoulder of the attractor, the 0.382 level. To keep the chart focused, I remove everything except the backbone and its upper shoulder. Now the key question becomes simple. Will the market defend this structure or lose it? To answer that, we need to move down to a lower time frame, where the internal behavior of price becomes much clearer. But before we descend into the fractal world, there's one more step. Identify the monthly block that the market is currently responding to and extract its center of gravity, COG, price zones. This gives me a structural pressure map that I can carry into the lower time frames. As I move down through the chart, I don't lose sight of the larger perspective. Instead, every lower time frame remains anchored to the structural framework established by the higher one. Notice something important. This COG has acted as the market's primary magnet for the past 2.5 years. Price has repeatedly gravitated back toward it, confirming its role as one of the dominant structural forces in the current cycle. Now we move down to the daily time frame. Technically, we've skipped the weekly chart, and yes, that's not ideal. Under normal circumstances, I would analyze every intermediate time frame. But for the purpose of this presentation, I'm keeping the process as clean and intuitive as possible. Adding every structural layer would introduce unnecessary visual noise and make the methodology much harder to follow. Learning technical analysis is, in many ways, learning how to transform noise into music. With experience, what initially looks chaotic begins to reveal structure, rhythm, and intention. On the daily chart, I identify the block that is capping price from above and the block that is supporting it from below. Immediately, the market's operating range becomes remarkably clear. The battlefield is now defined. We know where the boundaries are, and we know the structural pulses and key levels that are governing the entire move. What you've seen so far is only one layer of the analytical process. To perform a complete analysis of the yen, not a simplified demonstration like this one, can take a considerable amount of time. It requires building multiple structural layers, each one independently validated, until they begin to overlap and reinforce one another. The process can be painstaking, sometimes even exhausting, but it's almost always filled with moments of discovery. And that's where the beauty lies. I like to conclude every analysis the same way. An upper boundary, a lower boundary, and a center of gravity. 3 simple references that bring order to complexity. There is something deeply satisfying about finally uncovering them. After all the noise, after all the layers, the market reveals its balance. And to me, that's one of the most beautiful parts of technical analysis.